Hey everybody, my name is Brandon from thestockstunes.com, and today I want to talk about Tesla stock, ticker symbol TSLA, and how it is down over 16% in about a week. So now let's get started. So here we are on Google, and here's a 1 week view of Tesla stock charts here, and we can see what a rough week we have had for Tesla, off more than 16% in a single week. Of course, that is just looking at the stock under a single time horizon. To get the full picture of what's going on here, we should look at multiple time points. And we can see here that a 1 month view of Tesla is not looking too good either, off more than 17%. And if we look at the 6 month view here, we can see that we basically went nowhere in about 6 months if you count in the after hours action here. So as always, the question is why? Well, if we look down here at Tesla's numbers, and if we look at the market cap and price to earnings ratio that Google is reporting here, we are seeing that Tesla is reported at about a $790 billion market cap with a 155 price to earnings ratio. And here I think lies one of the reasons why Tesla may be falling back to earth a little bit here in the past 6 months. I think the sky high PE is definitely contributing to the fall because of the higher interest rates environment that we are seeing at the moment. Now, I've touched on this a bit in some previous videos such as NIO and Palantir, but rising interest rates affect higher price to earning ratio stocks. Today, I want to talk about how the risk-free rate of return that higher interest rates provide affect the higher PE stocks. You can look at my other videos to see some other ways that higher interest rates affect the high PE stocks. This may be a bit boring here, but bear with me. If I told an investor that I could guarantee a 0.0% rate of return if you gave me your money for 20 years, you'd probably laugh in my face and tell me to eat some sand. And that is definitely what you should do if I said that. However, what would happen if I told an investor that I could guarantee you a 50% return on your investment no matter what happens to the stock market or anything if you give me your money in 20 years? What if I could guarantee you a 100 or 500% return in 20 years? Then hopefully that will make you think a little bit harder before you tell me to eat some sand. Then maybe instead of telling me to eat some sand, maybe you'll instead cash out some stocks which go up and down and are highly volatile, as we have seen in the recent days, and instead shovel that cash raised from selling stock into a risk-free 500% return in 20 years. This is an extreme example, but I'm doing this to show you why guaranteed higher interest rates, which you get from bonds such as the 20-year bonds, may cause stock prices to fall. But of course, the 20-year is not guaranteeing a 500% rate of return right now. Right now, we're hovering around maybe a 2% return. But the concept is what's important here. If this 2% number increases higher, as the Federal Reserve indicated that it will, then now you have more options to get more return for lesser risk. This is one of the main reasons why higher interest rates have the potential to lower stock market returns, because bonds with higher interest rates are now more attractive to investors. Because investors like you or me only have a finite amount of cash, in order to make the most out of a risk-free opportunity, we might have to sell stock, which could, of course, lower stock market prices. Higher risk stocks are likely to get cut out first, and those higher risk stocks are the most expensive stocks, which are oftentimes indicated by PE ratios. So with all that said about the macro picture of interest rates rising and how it could affect higher PE, riskier stocks such as Tesla, now let's head on over to Tesla's most recent earnings report to see how Tesla is doing as a business. So here we are in Tesla's most recent earnings report, and they only show us the full year results for the most recent year in this column here of 2021, which is compared to a year-over-year view from 2020, and they also show us the year of 2019 as well. Starting off here with top line revenues, we can see the total revenues here for the year of 2021 is growing pretty nicely year over year here from 2020, with about a 70% growth from this $31 billion that we made in 2020 to the $53 billion that we made in 2021. And that is pretty fantastic growth. Nextly, let's move on down here to the costs of goods sold, which is all of these lines on the earnings report here. And we can see that the total costs of goods sold is increasing from about 24 or 25 billion dollars in 2020 to about $40 billion in 2021, an increase by about 66%. And that makes sense, as our top line revenues are again increasing by about 70% year over year, we should also be increasing our costs to generate those increased revenues. So that all is pretty good. It looks like we are able to maintain or maybe even improve our gross profit margins a little bit year over year, and that's definitely a good thing for Tesla. This conservation of profit margins carries on down here to the gross profits, which we see in this line on the earnings report here, from $6 billion in 2020 to about $13 billion in 2021. The next thing I want to talk about here is the operating expenses, which is this block on the earnings report here. We can see that year over year from 2020 to 2021, we are increasing our research and development spending as well as our sales, general, and administrative spending. We can see that total operating expenses here are increasing by about 50% year over year. Because we are increasing our operating expenses less than the rate at which we are growing our revenues here, and because the operating expenses is coming from a lower base number from 4 billion compared to the higher base number of total revenues, which is about 30 billion, that is how we are able to dramatically increase our income from our operations, which is this line on the earnings report here, year over year. And that carries down to the net income line, which is this line on the earnings report here, where we are able to see a nearly 7x increase in net income year over year from the $800 million we made in 2020 to the $5.6 billion that we made in 2021. However, remember that even though we are 7xing our net income, and that's a good headline, we're only making about $5.6 billion in net income. When, if you remember Google, this company is valued at about $789 billion. One of the ways you can think about it is that you're paying $789 billion to pay for a company that makes about $5.6 billion in revenues, and that is expensive. The last thing I want to talk about is that in the past, a large knock against Tesla was that they were only achieving positive net profits because of these automotive regulatory credits here, which were generating income. If we look in 2020, we can see that our credits were making about $1.5 billion in income. And if we look down at the net income here for 2020, we can see that we were only profiting about $862 million. Now, I'm no math major here, but if we take away this $1.5 billion from automotive credits from this $862 million from the net profit, then our net profit in 2020 would have been negative. So those naysayers who were saying that profitability was only reached because of regulatory credits, those people would have been correct. However, if we look here in 2021, if we look at the same automotive credits, we were able to make about $1.4 billion from those credits in 2021. Comparing that to the net income here for 2021, now we are at $5.6 billion. So now taking away this $1.4 billion from this net profit would still result in a net profit. So now those naysayers who were saying that automotive credits were the only reason why Tesla was making a profitable year are now proven incorrect. So after talking about Tesla's pretty good growth rate in all areas, but the risk of a high PE ratio, now let's head on over to Tesla's trading charts to see if there's a level or two to buy Tesla if we want to buy Tesla. So here we are in Tesla's trading chart, and we can see what a cliff we have fallen from the past few weeks. We are now at levels not seen since September or October of 2021, and we are actually at a pretty decent support level made from the tops of these candles over here, as well as the tops of these candles over here, back from April of 2020. The support level is around the $750 to $770 level, which we are smack in the middle of right at the moment, where we are at about $764. However, as you all probably know, the stock market is incredibly volatile at the moment. There are geopolitical risks. There are risks of rising interest rates. The S&P 500 and the NASDAQ now move at integer percentage points, which is honestly insane. While the $750 level may have looked like a great level to start stepping into Tesla at, I would still be cautious, extremely cautious, with making any big moves right now. If I wanted to put money into work into Tesla, like I said, I think this $750 to $770 level is a good level to start. But I would be going slow. I would be buying, maybe 10 to 20% of what I want my position to be at a time over the course of days or weeks. If we drop below the $750 to $770 level, which I'm sure is a definite possibility, then we could be looking at this level down here around the $720 level, splitting the difference from these bottoms of these candles over here and the tops of these candles over here. Or we could fall to this level around here from the tops of these candles to the bottoms of these candles around the $700 level. Or we could fall even further to this level down here from the bottoms of these candles all the way back down to the 630s or 650s. Now, if we zoom on back in here so that we can take a look at the MACD and the RSI charts here, we can see that the blue line short-term momentum here is below or weaker the orange line long-term momentum here, which is a bearish sign. If we look at the RSI chart here, the relative strength index, we can see that our RSI line is just about to touch the oversold territory, which is below this line here. If we touch the oversold level, there could be some reflex buying in Tesla. So we could see a short-term bounce. So that was my review on Tesla stock. Let me know what you thought about it in the comment section down below. If you have any questions or if you got any mistakes, also drop me a comment down below. If you liked the video, please like the video. If you haven't subscribed yet, please subscribe. And as always, thanks for watching and I hope you have a great day.